What if the most powerful force shaping your life isn't inflation, taxes, or corruption, but something so normal we never question it? Every government fears it. Every bank depends on it. Every household pays it, yet almost no one understands how it slowly turned entire economies into permanent debt machines. Interest, not as a number, not as a rate, but as a system. Because here's the paradox: if money is created as debt with interest, where does the extra money come from to pay it back? That question was asked centuries ago, the answer was postponed, and the consequences are now global. For most of human history, money was limited by reality: gold, silver, land, labor. Lending existed, but interest was controversial. Ancient civilizations, from Mesopotamia to Rome, repeatedly banned or capped it after debt crises collapsed societies. Aristotle called interest money breeding money unnaturally. Religions condemned usury. Empires learned, then forgot the same lesson. The shift began when money stopped being something and became a promise. By the 1600s, European banking families realized something revolutionary. Money didn't need to exist first to be lent. It only needed legal backing and trust. When central banks emerged, most famously the Bank of England in 1694, governments found a new way to fund wars without raising visible taxes. Borrow now, pay later, forever. Interest became normalized, debt became patriotic, and money quietly became abstract. When banks lend money today, they don't lend existing funds. They create new money as debt digits typed into existence. But here's the catch: only the principal is created. The interest is not. This means the total debt in the system is always greater than the total money available to repay it. The system requires defaults, bankruptcies, and expansion to survive. To prevent collapse, economies must grow continuously. When growth slows, crises appear. When growth stops, systems break. Interest isn't just a price of borrowing, it's a pressure forcing constant expansion whether societies want it or not. During the Industrial Revolution, interest-powered, credit-fueled massive growth. Railways, factories, empires all financed through debt. But the model had a hidden requirement: exponential growth in a finite world. By the 20th century, governments fully embraced interest-bearing debt. Central banks standardized it. Financial markets weaponized it. After 1971, when the last tie to gold was severed, money became pure debt. From that moment on, every dollar, pound, or euro required interest to exist. Debt was no longer a tool. It became the foundation. Eventually, the system hit its limits. Wages stagnated. Productivity gains flowed upward. Households replaced income with credit. Governments replaced savings with bonds. Each crisis followed the same pattern. Excess debt builds quietly, defaults threaten, collapse, central banks intervene. More money is created as debt. The cycle accelerates. 2008 wasn't an accident. It was a mathematical inevitability. And the solution wasn't reform, it was more interest-bearing debt. Interest transfers wealth upward. always has. Those who own assets receive it. Those who work for wages pay it in mortgages, credit cards, student loans, taxes. Entire nations now function like leveraged households, borrow to survive, pay interest to exist, never reach zero. Even when debts are paid, new ones replace them. The system cannot allow mass debt elimination without collapsing itself. Freedom quietly shrinks not through force, but through obligation. Rate cuts, temporary relief, stimulus, delayed consequences, austerity, economic self-harm. Every fix avoids the core issue. Money creation itself is inseparable from interest. Attempts to escape jubilees, resets, restructuring have occurred throughout history. They work briefly, then interest returns under a new name. Because the system doesn't just allow interest, it requires it. Global debt now exceeds global GDP multiple times over. Governments can't repay, they can only refinance. Central banks claim control, but they're trapped by the same math. Raise rates too much, and the system breaks. Lower them too long, and money loses meaning. The paradox tightens. Digital currencies, financial surveillance, and programmable money aren't solutions. They're attempts to manage the consequences of a structure that cannot resolve itself. History isn't repeating, it's accelerating. First, interest isn't neutral. It shapes power, behavior, and survival. Second, a debt-based system can never be stable, only postponed. Third, societies collapse not when debt exists, but when it becomes unavoidable. The open question isn't if the system changes, it's how and who pays when it does. Because every historical reset came after denial lasted too long. Interest didn't enslave economies overnight. It did it quietly, legally, respectably. And once you see the structure, you can't unsee it. If this made you rethink money, debt, or freedom, subscribe, because understanding the system is the first step toward surviving what comes after it.